Futures Radio Show, sponsored by CME Group, the world's leading and most diverse futures and options exchange. CME Group's markets help individuals and businesses around the world effectively manage risk. For access to free educational tools and resources for the active individual trader, please visit activetrader.cmegroup.com.
Every day, traders and investors dive in to tackle the ever-changing markets to find opportunity. Futures Radio Show is your number one source for answers to the questions that all market participants want to ask. Veteran futures trader Anthony Crudele sits down with the most influential leaders and top traders in the industry. Now, here's your host, Anthony Crudele.
Hey everybody, thanks for tuning in for this special episode. I spoke with 4 great guests at FIA Boca on important things happening in the futures industry. Remember, new shows are posted on Mondays and Thursdays. You can subscribe to the show on iTunes and YouTube. If you're enjoying the show, please leave a review on iTunes. Before I play today's interview for you, I want to give a shout out to the great sponsors of Futures Radio Show: CME Group, Trading Technologies, RJO Futures, and Top Step Trader. To learn more about these sponsors and the important things they are doing for futures traders, be sure to click on their logos on our website. Today I spoke with 4 great guests. First up, you'll hear from Blu Putnam, Chief Economist and Managing Director at CME Group. He gives us his thoughts on the Fed and the economy. Next, the CEO of Modern Markets Initiative, Kirsten Wegner, talked to us about the financial transaction tax and other important issues traders should be watching for coming out of Congress. Next up, I sat down with Tim McCourt, Managing Director, Global Head of Equity Index and Alternative Investment Products, gives us details on the new micro E-Mini S&P, Dow, Russell, and Nasdaq futures. Last but not least, I spoke with Jim Downs, CEO of Connamara Systems. Jim is a very interesting guy who worked for the CIA, then became a successful market maker at the SIBO, and transitioned over to creating custom trading applications and risk tools for traders. So without further ado, let me bring you right to the interview with these great guests. Blu, thanks for coming back on the show.
Oh, thank you.
It's always great to speak with you, my friend, and today we actually get to talk in person here at FIA Boca.
In person.
How'd you play tennis this morning?
I could have done better. My serve wasn't as sharp as usual.
I mean, I can't tell you how upset I am that I wasn't there this year to take advantage of it.
You could have taken advantage of me big time.
Because last year, if anyone listens to this show, you remember Blu kicked my butt a little bit. So anyway, we got to get past that. I have to get past that, Blu. What are your thoughts right now on what's going on with the Fed?
Well, you know, the Fed's between a rock and a hard place because they were tightening up for 2 years. And then they really had the wrong metrics for how tight to get. You know, they were on an autopilot, and they just wanted to raise rates and raise rates. And what Janet Yellen had and then Jay Powell had is, look, we're at neutral when the Fed funds rate's a little bit above the inflation rate. But really, they should have been looking at the yield curve. And when the yield curve went flat, they should have stopped. So they got a wake-up call in the fourth quarter from equities, and they stopped. So, you know, they're on hold.
What yield curves are you watching specifically?
I tend to watch the 2s, 10s, but they're all pretty flat. They're a little bit positive. 2s, 10s slightly positive. 530s is slightly positive.
So for me, I like to watch the 210 a lot and the 530. And what I've been noticing is that the 210 just is stuck, and it just continues to flatten ever so slightly, but it just keeps getting flatter. It's definitely not steepening. And then that 530 actually had a little pop on the steepening side, and now that's just kind of sitting there. What do you think that means?
I don't think it means too much. What happened there is the 5-year actually dropped in yield. So the 2 5s is inverted by all of 4 basis points. So I think there was just a little movement on the yield curve. I think it's technical. I'm not worried about it.
A lot of people talk about how the 210, if that were to invert, that would indicate a recession. I've spoken with many people on this show about it, specifically Ira Harris, whom I read religiously, and he has talked about how in the past that has indicated a recession. What are your thoughts on that?
The 2s, 10s, or the shape of the yield curve is one of the best predictors of a future recession that we have. I mean, if once that curve flattens out, the next 12 to 24 months, you're definitely going to see more equity volatility. That happened. And you may or may not see a recession, but things are going to slow down, and that's obviously happening. As economic indicators go, it's one of the more reliable.
So talk to us a little bit more. You said that the Fed got a wake-up call from equities, even though they say that they don't watch the equity markets, right, Blu? We all know that that's kind of not true. But talk to us about what you see the Fed doing going forward.
Well, the Fed has some issues. There really isn't any inflation pressure. So we're like at 2% inflation. Maybe we'll up at 2/10, down a few tenths. I mean, we're at 2%. And by the way, we've been there since 1994. This is not like something new. The Fed has lost the ability to create inflation. They don't like to tell you that, but they can't do it anymore. I mean, they can try zero rates, they can try quantitative easing. It didn't create inflation. So that's one of the issues. The other issue the Fed has is the trade war. The trade war is absolutely hurting China, but it's also hurting the U.S. by way more than the U.S. administration realized. And so, 2019, the economy is decelerating, and the Fed's going to get nervous, I think. So, the probability of a rate cut is real.
Well, that would be something to see, I think. But I want to go back and talk about some of the data points that you think the Fed is watching. Obviously, after this latest non-farm payrolls at 20,000, I think that everyone was looking at that in shock. I don't really know anybody who even guessed close to that. Maybe somebody out there will write in and say who did. But do you think that the Fed is watching the unemployment data the closest, or what data points are they watching right now?
The Fed is very focused on the number of jobs. And, we had a really big numbers ahead of the last week one, so I average them out, so it's not that big a deal. The Fed's looking at the unemployment rate and seeing if it starts ticking higher. It ticked down, but it ticked down for the wrong reason, which is the labor market, the participation rate. So those are the three things they're really looking at, is jobs, unemployment, and participation rate.
I want to talk about some of the trades off of what you're saying. Now, I know you're not trading, but you are really good at identifying what trends may continue or may not continue. Mm-hmm. And give us an idea of what markets you think we should be watching, where these trends may continue or not continue based off of some of these fundamental analysis we talked about today.
Well, the big thing is the trade war. If we get a deal that allows the U.S. to take the tariffs off, then the economy's still going to slow down, but it won't go into recession. If these tariffs stay on or we get more tariffs, then the recession probabilities just keep going up every quarter. And by the way, we're not talking deal. It doesn't matter what the deal is. It only matters if the tariffs come off or not. The tariffs are where all the damage is coming both to the U.S. and to China. And it's hitting some sectors that weren't ready for it in the beginning. Automobiles, they were already sluggish before the steel and aluminum tariffs. Now they're in trouble. So, this thing is really hurting. And of course, it hurt the farmers big time in the U.S. So the economy is decelerating, and if these tariffs stay on, it's going to get worse.
So what markets specifically do you see, and I know we're going to get a little technical here, but on the charts where you see these trends continuing, that traders at home could look at and say, you know what, I understand this fundamental analysis, but how does it come into play where they could go out there and where they see that stuff impacting specific markets? Well,
the U.S. has a lot of debt. It has government debt, it has consumer debt, it's got a lot of debt. And interest rates did go up the last couple of years. So look at what people buy on credit. The first thing they buy on credit is a house. Housing market slowed down. Next thing they buy on credit is a car. Car market is stagnant. The next thing to come will hit some consumer discretionaries. But, so look at housing, then you look at automobiles, and then you can move into the higher-end consumer discretionary items. That's where debt hits you, and that's what's happening.
So you see those trends continuing, those slowdown across all those different sectors you're discussing?
Unless we get a break. And the breaks are, we get the tariffs taken off. That would be a relief rally for equities. Or the Fed decides to give us a break and lower rates. And the Fed might do that, but it's the second half of the year. It's not first half.
Kirsten, thanks for coming back on the show.
Hey, thanks so much for having me on, Anthony.
It's great to speak with you in person here at FIA Boca. Give everybody a quick overview of what you guys do at Modern Markets Initiative.
Sure. So Modern Markets Initiative is an education and advocacy association founded by automated trading firms. And as we've kind of matured, we've become more and more a research and data collection firm as well. Our mission really is to educate the public and lawmakers on market structure issues to help make sure we have the best markets ever for investors.
Take us through a little bit of what you guys are looking at on a regular basis and deciding what issues to tackle and help traders and investors with.
Sure. I mean, one of the key components we're looking at is kind of the cost of trading, right? I think everyone cares about how can we make the cost of trading less. I think we've seen the cost, the spreads come down over the past decade. That now the cost of trading has, I think, dropped by 50%. But we also look at legislative proposals that might increase the cost of trade and widen spreads. So one of those proposals that's floating out there that we're looking at and following closely is the retirement tax, otherwise known as the financial transaction tax.
And you just recently wrote an op-ed about this in the Financial Times. Talk to us a little bit about that.
So there are a number of lawmakers that have continued to reintroduce the retirement tax each year. Bernie Sanders has reintroduced it each year. Keith Ellison in the House has reintroduced it, and now AOC as well. And these taxes fundamentally would impact the retirement community. Some of the proposals have a tax as high as 50 basis points on the sale of securities, and you're seeing half a basis point on derivatives, which definitely impacts the futures industry, and 10 basis points on bonds. So these are not, small numbers, and collectively they add up to a large, burden on end users.
Yeah, those numbers are big. And what I'm curious about is you name some of the people that are proposing this. How many people besides them are really looking at this as going, hey, this is something that could pass?
So I think so far we haven't seen that much Republican support for a retirement tax. When you look at the Democrats on the financial services and tax writing committees, you haven't seen mainstream buy-in so far. It's been mostly, I'd say, individuals who are kind of vested in this idea of having a tax proposal to pay for, let's say, social benefit programs like free college or otherwise. However, I do sense that there is greater traction, gaining as we see the Green Deal come out and AOC, come out in favor of this as well. So largely the people who've supported it have been those who maybe don't have a financial services background and may not totally be aware yet of the negative impact that this proposal would have on their very own constituents.
For everybody out there listening, probably thinking to themselves, Anthony, how does this directly impact the futures industry?
Well, I think, when you have a tax that is imposed on derivatives, you're going to be, taxing futures as well. And you've got the bond trading tax and equities tax. So anyone who's, trading across different asset classes is going to bear the weight of this. And also when you look at the jurisdictions in which a financial transaction tax has been embraced, you see a very negative history. In Sweden, they had a financial transaction tax briefly. It reduced the trading by 50%. The trading just went elsewhere. So I think if you're a futures trader and you want a healthy, vibrant market, you don't want that trading flowing to another jurisdiction. It just limits your opportunities, and it would have a very negative impact.
Now, talk directly to those mom and pop investors out there and how this would directly impact them.
So, if you're a mom and pop investor and you are, let's say, like a teacher or a fireman who's counting on your pension fund to pay for your retirement, Modern Markets Initiative did conduct a study in the past year that's on our website. But we've analyzed a variety of state and federal pension funds. So as far as the mom and pop investor impact, we found one city employee fund from New York with about $150 billion of assets under management. Now, the financial transaction tax burden was $1.3 billion a year. That's over $1 billion a year for one state pension fund. And then you can run the gamut. There's another state pension fund that had $300 billion assets under management that would owe $200 million. It's really, how those investments are apportioned, whether they're actively managed or more passively managed assets, and what the turnover rate.
Are asset managers that you know of pension funds making their clients aware of this?
I get the sense that there's still a lot of education to be done. When the asset managers hear about this, and when the pension fund trustees hear about this, they're very interested in learning more. It's, the numbers just kind of speak for themselves. So I think, it's very important to share this data with the public, because it's important to have an educated group of pension fund trustees, understanding the negative impact this would have on their own organizations.
Yeah, absolutely. I mean, this is why I have you on the show to explain this to us, because let's face it, I'm not out there looking at these types of things. And I've said to people many times on this show, it's not just about the charts. It's not just about the fundamentals. You have to know what's going on in our industry that could impact us. We've all seen rules over the years that have been implemented and hurting our business, for us as traders.
And one kind of interesting bit of historical trivia, sometimes people ask me, well, has the U.S. had a financial transaction tax before? And the answer is yes. The financial transaction tax in the past was repealed by a Democratic president. The last one was in 1965, and the cost to trade was 95% higher than it is now. So if you go back to 65, it cost $25 to buy or sell 100 shares of IBM. And that's not including fees. Right now that cost is $1. So the cost to trade has come down dramatically, and we know that if there is a financial transaction tax, the cost to trade is going to go back up. And that also is a net negative for mom and pop investors, pension funds, the whole financial ecosystem.
What do you think happens next with this financial transaction tax?
So I get the sense that this is something that will be, talked about in one-on-one meetings. I'm sure Bernie Sanders will be seeking more co-sponsors. Over the years, he's only managed to get one additional co-sponsor to this idea, if that gives you a sense of political traction. My hope is that the pension funds will write letters to their member of Congress, opposing this, that 401k holders will write letters in opposition. So that the whole retirement kind of community and kind of ecosystem around that really alerts their member of Congress that they believe this is a bad idea.
What are some of the things that we as traders should be keeping an eye on potentially coming out of Congress?
Well, I think there's a lot of continuing analysis over kind of regulatory reform. What have we gotten right or wrong with Dodd-Frank? What tweaking might there still need to be done? I think there are a lot of unimplemented sections of Dodd-Frank that some of the Democrats are still looking at. Why haven't we gotten this done? And so that is one thing. I think Consumer Financial Protection Bureau is another thing people are looking at. Is the leadership structure something that should be tweaked? Some people support kind of having more of a commission than a single commissioner. I think we're going to look at a lot of questions from Democrats on stock buybacks and whether that is the way that companies should allocate their capital. I think we've heard regulators say, that they're not in the business of making decisions for company on capital allocation, but it's certainly a question that's been very politicized when you have a company, let's say, lay off a lot of people and then do a stock buyback. That's something that optics-wise has made some of the Democratic members very upset. So we're going to hear a lot of talk about stock buybacks. I think there's also going to be, ongoing discussion over executive compensation, of the wealth gap between CEO level and the lowest earners. I was at a breakfast with a Senate Democrat who's very engaged with workforce dignity, and he noted that executives should be looking at what they're paying their people, their cafeteria wage workers, and not just focusing on the C-suite. So that's kind of a sense of the rhetoric we're going to hear, and I think it's always important. Anyone who's listening to this, you're a constituent, you have a member of Congress. If there's something that you care about, you can write a letter to your member of Congress. You don't need a lobbyist to do it. So if there's something you see in the news that you don't agree with, whether it's financial transaction tax or some regulatory reform issue, you can write a letter to your member of Congress, and it does move the needle in some way, because they actually do listen to constituents.
I tell everybody, before you do anything in trading, do your homework. And, with these types of things, this is definitely not my specialty, but it's always good to hear from people like you, and that helps me understand it. But where can people go and learn more about this stuff? Is there maybe something on your website or a place where we could go to see the things that are directly impacting our industry?
Sure. So we have actually just refreshed our website, so I'm happy to unveil the new and improved modernmarkets.org. You can go to modernmarkets.org or modernmarketsinitiative.org. And we have easy to access studies on there. You can go to the issue section if you want to learn more about financial transaction tax as a retirement tax. We have a new link on our website. So, I invite everyone to come and check it out.
Hey everyone, I hope you're enjoying the show so far, but I want to pause and thank one of our sponsors, Trading Technologies. I started using TT in the year 2000, and I love it. It is by far the best trading platform I have ever used, and I've tried a lot of them. With TT, you can trade the global markets from virtually anywhere in the world. They are the world's fastest commercially available futures trading platform. I highly suggest you go try out TT, especially because you can try it for free. Just go to tryttnow.com and set up your account. Tim, welcome back to the show.
Great. Thanks, Anthony. Thanks for having me back.
It's great to be with you live here at FIA Boca, even though this is recorded, everybody. We are live sitting next to each other, which is fun for me instead of being behind the desk and being on the phone with you all the time. But yeah, you know what, Tim? What's really interesting to me is the micros. CME just put out an announcement that the micros are coming in May. Talk to us about that.
Yeah, it's an exciting time here at CME for the market and for our customers. As you saw earlier this week, we announced the launch of the Micro E-Mini Equity Index Futures at CME Group, where in May of 2019, we will be introducing contracts on the Micro S&P 500, the Micro Nasdaq 100, the Micro Russell 2000, and the Micro Dow. So truly an exciting time, and what really excites me about it, and what's exciting people here down at Boca, is this really will provide a more accessible on-ramp for the active individual trader to trade global equity index products at CME Group.
So to me, it sounds like there was demand for this, obviously, right? I mean, you're not going to put a product out that there's not demand for, but I guess I'm curious about the process. How did this all come about? Why did you guys sit down and say, you know what, let's create micros for these products?
Yeah, it's a great question. And at CME, we're very focused on customer demand-driven product innovation and product development. And I think Micro E-Mini futures are just another example of that in recent years. So when we look at the customer demand, it really came from a few different areas of the equity ecosystem, and mainly the active individual trader who was looking to trade either more futures, but was perhaps constrained a little bit in terms of the capital usage of their account, or someone who was actively trading other parts of the equity ecosystem, whether it be single stocks, ETFs, CFDs, but futures always provided a little bit of a hurdle for them to get involved, and this just lowers that hurdle in terms of making it more approachable and more accessible for them.
Yeah, personally, I love this. I think this is a really great idea that CME is doing this, because what I really am excited about is the ability for a new trader to come in and to be able to trade a micro product of a product that they want to eventually grow into without having the same tick size as the bigger product. Talk us through some of this product specs on these products.
Sure. So the equity futures that we announced this week, the Micro E-Minis, they're going to be 1/10 the size of the regular E-Mini contract at CME. So that means the E-Mini S&P 500 has a $50 multiplier. The Micro E-Mini S&P 500 will have a $5 multiplier. So they're all going to be 1/10 the size, which makes it much more approachable. To kind of put that in perspective, right now the S&P 500 contract is about $140,000 in terms of contract value of the E-Mini. The Micro E-Mini will be about $14,000 in terms of notional, which will require plus or minus about $700 of initial margin as opposed to $7,000 that the E-Mini would. So it really makes it much more approachable. But in terms of how the contract will work, it's going to have the same tick size or the minimum price increment as the E-Mini contracts. So we'll look and feel a lot like the existing E-Mini market structure and ecosystem. And what I'm excited about this is when we work with not only our retail partner platforms out there, but also all of our liquidity providers in the E-Mini contracts, this really will tap into the existing near 24-hour access liquidity of the E-Mini contracts, but offer it into the Micro E-Minis. So it's really availing not only some of the most liquid equity index contracts on the planet to the active individual trading community. It's also offering it to them 24 hours a day, which is something that they don't necessarily find in the cash markets either.
So it's going to mirror the exact time for open and closes and everything as the bigger product.
That's correct. Same trading hours, same tick size, same trading hours. Should be relatively the same margin in percentage terms, which we're still finalizing, just 1/10 the size.
Yeah, maybe this is a dumb question. I don't know. I mean, I've never traded micros, so I don't really know if there's like options or anything on there. Is it even something that you guys have ever even considered, or are there options on other micro products?
Yeah, right now we're focused on introducing the micro E-Mini futures. One of the things that we'll keep an eye on is if they become successful and viable to support options, we'll certainly look to continued customer demand for that. But I think when we think about the evolution of a trader who might be using the micro contracts, is that over time, if they are attracted by the willingness or the wantingness to trade options, they probably will more likely move into trading E-Minis and our options on E-Minis, which is already a hugely successful offering at the exchange. So I think it will depend if options need to be developed in isolation for the micros, or do they get more comfortable trading micros and trade E-Mini options?
What I'm noticing in what you guys are doing at CME Group is there's true growth in retail. That's what it sounds like to me, because you guys are expanding products with these micros. And something, when I had heard the micros were coming out, I went and looked at some stats. And what I thought was very interesting is that volume, non-institutional trading volume, was up 27% with the average daily volume of 660,000 across all CME products. That's good. I mean, that's really big. I mean, I'm excited about that.
Yeah, it's great. I mean, I think it's better than good. It's great. When we look at the growth this segment has had at CME, it's been phenomenal year over year. And 2018 was no exception with those stats that you provided. And then when you look at where some of that 660,000 contracts per day and average daily volume is coming from, if we look at the top 5 products, you have the E-Mini S&P 500, WTI, the E-Mini Nasdaq 100, gold, and then the 10-year Treasury note. So 2 of the top 5 products are already the E-Mini S&P and E-Mini Nasdaq. So it makes great sense that the next product innovation we're deploying to further advance this trading community are the micro E-Mini S&P, micro E-Mini Nasdaq, as well as the Russell and the Dow. So the fact that 2 of the 5 most popular products in this segment are already equity, it was very easy for us to see and hear the customer demand to launch micro E-Mini equity index futures as the next product extension.
Yeah, it doesn't hurt the products at all, because this is truly, to me, a gateway for people to get into the bigger products. And also, something I don't think is really talked about yet is that if you're a trader who's trading the E-Mini S&P and maybe you're going through a slump or whatever, you're sitting there going, you know what, I don't want to put a lot of risk on right now, you can go and trade the micro.
That's right. Not only in terms of just looking at the opportunity to scale up or scale back your exposure to equity index futures, where you may not want that 140,000 or a few of those 140,000 contracts sitting in your portfolio. The other thing that I'm excited about is the introduction of a more precisely or right-sized notional contract at $14,000. It also doesn't force an active individual trader to make the either-or decision they might be making. If they want to cycle out of futures into ETFs or single stocks, or they liked a certain trade someplace else in the market, they were often forced to liquidate their entire futures position to free up capital to chase some of those other opportunities in the market. Now they could trade them concurrently, or they could trade a handful of micro E-Minis in lieu of 1 or 2 E-Mini futures, and if they need to free up some capital to trade elsewhere in the ecosystem, they can do so without having to be forced to liquidate a future position. So I actually think this is an exciting opportunity for those active traders in the equity ecosystem, because they already are active, and now they can be more active in all of the available products around the same global equity indices.
I mean, that makes perfect sense. And you made another great point, is not only, as I mentioned, maybe the trader's in a slump and he wants less exposure during the day, but I think the other thing is going into the weekend with a position, or trading overnight. Maybe you don't want a full E-Mini on. Maybe you just want a micro on, so you still get some exposure, but not as much as having the single E-Mini contract on. I mean, I love all of this. To me is very positive.
Yeah, I think that's right too. And you mentioned an interesting point too, especially around trading at nighttime, where when we've seen, in the past few years, we've seen market moving events happen outside of the U.S. cash equity trading day. We can look at things like the Brexit vote, the 2016 presidential election, the U.S. midterm elections. These are kind of market moving events that are happening at night from a U.S. perspective, and the cash equity market is closed. And E-Minis did phenomenal those days in terms of volume, but they are a large contract. So now offering a contract 1/10 the size avails the active individual trader to be able to participate in or risk manage during those market moving events at night, which they can't do currently with the products they have in their portfolio.
Jim, thanks for coming on the show.
Well, thanks for having me, Anthony.
It's great to speak with you here at FIA Boca. Jim, how'd you get involved in the markets?
Well, when I was in senior in college, my last semester, I took a personal finance class, which was basically how to balance your checkbook. One section of that was about the markets, and at the time, the CBOE was pretty new, and they did a feature on a fellow who came to Chicago, started making markets at the CBOE, and made his fortune. And to me, that sounded like a pretty good way to make a living, deep money.
It's the hardest way to make easy money.
Yeah.
Jim, when I was reading about your background, man, was it interesting. Honeywell, CIA, Beltway Bandit Consultants to market maker at the CBOE. Take us through your journey to becoming a trader.
Yeah, well, as I mentioned, that course at Purdue actually was pretty much a turning point in my career. I left Purdue, went the typical route, worked as an engineer at Honeywell Avionics in Minneapolis, but all that time I was fascinated by trading options. And I was more fascinated with the Black-Scholes formula being an engineer. So I actually programmed up the Black-Scholes formula on an Apple IIe. I went from there and I dropped some money in an account at Merrill Lynch and proceeded to lose it all pretty quickly trading options. You could only go long, so basically I just watched the money erode. So from that point, I figured, well, if I'm losing this money, somebody else is making it. So I researched how to become a market maker on the CBOE, what it'd take to be on the exchange. And I was newly married, so my wife and I saved our money and got enough money together to come out to Chicago and start trading, start being a market maker on the CBOE.
It's very interesting to me. And talk to me a little bit about before you became a market maker. I mean, working at the CIA, I know you probably can't share any stories with us. Feel free if you wanted to, but no, I understand that. But talk to me about how much your life has changed or what you had to go through in changing day-to-day mental thinking to becoming a trader.
Well, the thing I did not understand when I came to the floor of the CBOE was how much self-discipline it actually required. Working in a regular job, I mean, I don't know that day-to-day how much self-discipline actually enters into it. But that was probably the biggest change I had to have. I mean, all the time I was working at Honeywell or at CIA or at the Beltway Bandits outside DC, I always was just dreaming of becoming a market maker. It was one of these things that just got under my skin from that class at Purdue, and I wasn't going to let it go.
Yeah, it's amazing. Even someone like you, Jim, you were in the CIA and you're thinking about trading. And that's what happens once you trade a little bit. It really is, it's contagious. You just want more of it. What I want to talk a little bit about is you've obviously seen a lot in your career, in your different careers, and you went from being a successful market maker to now owning Connamara Systems. How did you make the decision to go from being a trader, market maker, to then working behind the scenes on trading technology?
Well, there was like these parallel tracks in my life at the time. One was that when I came to the CBOE, the whole idea of financial engineering or using modeling to model prices was really pretty new. But using my engineering background, I was able to do that. And I was continue to write software, because I was an electrical engineer, continue to write software to do financial modeling, position management, all the things that we kind of take for granted today, I was writing on my own. So it wasn't one of these things where it became very natural when I decided to leave the floor after 17 years to just keep writing software. I felt like I had something to offer, and at the time, it was right at that critical moment where we were going from transitioning from the floor to electronic trading. So I was kind of at this fortunate place where I knew enough about writing software, but I knew a whole heck of a lot about trading and markets that I could apply it to start this company, Connamara.
Yeah, it's very similar to my backstory. I mean, I started in the pit, and then I ended up, right at the time that I had started in the pit, electronic trading was being just really put out there, the E-Mini S&P, and I had a computer as a kid, and it was just a real easy transition for me. I'm like, hey, you know what? First of all, I wasn't a good pit trader, so it was kind of an easy decision to go on the screen because I figured at least I could trade with people because nobody traded with me in the pit. But that's a whole other story, Jim. But I think that what I find to be really interesting is that you had this whole involvement over your career, different things you've done, and then you sit down, you take the skills that you've learned, and then you build this company called Connamara Systems. Explain to everybody what it is and exactly why that's the route you decided to take.
Well, Connamara Systems we're really a software engineering firm dedicated to capital markets. So over 20 years, we've built all sorts of platforms for our clients, anything from pre-trade risk to post-trade risk to HFT systems and to exchange platforms. So almost anything involving trading and software, we've actually written that software for someone. The reason why I started it was it just felt like a natural evolution from leaving the pit, and it was a skill that I had. As I mentioned, I knew a lot about trading, and I knew some about programming. One of the things that I also understood from the first day I walked onto the floor was that there were a lot of people around the trading industry that were making a lot of money. Not just the traders. So the guys that rented and cleaned the trading coats for you, they were making money every week. The guys, the Lazar printing, who would print the trading cards, they were making money every week. One time I considered looking at purchasing Lazar printing. I'm glad I didn't. That would have been a really bad buy. But I always thought had this idea of the guys, the people making money in our industry, day in and day out, were the ones selling the pickaxes and shovels to the miners. So when I wanted to come off the floor and stop being a quote-unquote miner, I tried to figure out a way to sell pickaxes and shovels. And that's really to the miners, and that's what Connamara actually does. Is we give the tools to traders and trading firms that allow them to mine the gold. And that's sort of was a natural evolution for me. There was a seed was planted from the first day I walked on the floor and saw all those other little businesses running around the exchanges, that maybe there's a way to make money, from this and stay in the industry, and sell the pickaxes and shovels.
Gotcha. No, I totally get that. And for all the traders out there that are listening right now, explain to them how Connamara Systems can help them.
Well, one of the ways is that we've helped clients in the past, and traders in particular, is that let's say they use a commercial trading platform, and to enter their trades, to maybe manage the risk or whatever. And maybe there's something that they feel like that platform is lacking. And what happens then is that the trader then asks their sales rep for, can we get this change put in the platform? Well, you're just one person in this engineering queue, and for you to get that done, a lot of people would have to want the same thing. And maybe this thing you want to have done is actually something that you feel is your edge. So what we've done in the past for traders is they would be using a commercial platform, and a vended platform, and they would say, can you rebuild this functionality for us, and we can get rid of the ISV platform? And yes, we can do that. So we built platforms for traders that actually replace vended platforms, but it allows them then to make the changes that they need, that they feel like is their edge, and not have to wait for an engineering queue, or not want that edge to be put into the vended platform that everybody else could use.
I get that. Is it for within the platform? Is this for automated trading or point and click or both?
It's both, actually. typically automated trading is where we do most of the work in that regard.
So I'm just curious, how many of your customers are point and click versus automated?
I would say probably 90% are automated.
Market connectivity, does this work with multiple different types of brokers? Like if I had this software that you built for me, I guarantee a lot of people are out there saying, well, how do I connect it to the exchange? Like, how does that work?
Well, I mean, early on in the early 2000s, Connamara was instrumental in creating an open source library called Quick Fix, which is it implements the Fix protocol, which is the protocol that most applications connect with to exchanges or to other trading venues. So that's kind of our street cred, is that the Quick Fix, the open source libraries that we built, are probably one of the most influential open source projects in capital markets. We've been getting roughly 1,000 downloads a month of this library since probably early 2000. I think 2002 is when we released it. It was the first release. Yeah, we just handle that connectivity. That's what we do. We connect you to the exchange.
Jim, where can people find you on social media, and give us a website to check out?
www.connamara.com and at Connamara Systems on SYS on Twitter.
Jim, thank you so much for joining me on Futures Radio Show.
Thanks, Anthony. It's been a pleasure.
Thank you for listening to Futures Radio Show. If you have any questions or comments for myself or my guests, please visit futuresradioshow.com and sign up to be a premium member for free. If you enjoyed the show, don't forget to leave us a review on iTunes.